Good afternoon, good evening, depending on where you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this new session of financial statements at the Peterson Institute. Today, we go back to China after having spent some time in Russia and Ukraine, but we'll get back there because it's so important right now. We have unusually in the session today, two political scientists, but it's all about politics in Chinese stock market, so this is appropriate. John Yasuda, I'm very grateful actually that John joins us barely more than a week ahead of his wedding. Congratulations in advance, John. John studied government at Harvard, where he got his BA in 2005. He studied comparative politics at Oxford with a Master of Philosophy in 2007, then political science at the University of California, Berkeley, where he got his PhD in 2013. He's been affiliated with a number of academic centers, with the Center for Agricultural and Rural Development at the Chinese Academy of Agricultural Sciences in the early 2010s. He's done his postdoc at the Center for the Study of Contemporary China at the University of Pennsylvania. 2013-15, and he taught at Colorado College, at Indiana University, and since July 2020 as assistant professor of political science at Johns Hopkins University next door in Baltimore. He's also been a visiting fellow in Cambridge in the UK at the University and St. Catherine's College in 2018-19. He's published widely, and he's got a book on the politics of food and agricultural policy in China, on feeding the masses, an anatomy of regulatory failure in China, published in 2017. I don't know if today's presentation on stock market will also be an anatomy of regulatory failure, but I'm looking forward to that. Yeling Tan got her BA in International Relations and Economics at Stanford University in 2002. She then was a Tom Ford Fellow at the Asia Foundation, but then went on to serve in the Singaporean Ministry of Defense from 2003 to 2007, where she worked on the Indonesia desk and then on the US desk, which she headed. After that, she was a research fellow at the Lee Kuan Yew School of Government at the University of Singapore. She was a consultant for the World Bank. She got an MPAID, a Master of Public Administration and International Developments at the Harvard Kennedy School in 2011, her PhD in Public Policy at Harvard in 2017. Meanwhile, a number of stints at Peking University in Beijing, also at Tsinghua University, also in Beijing, postdoc at Princeton in 2017-18, and since then, she's been assistant professor of political science at University of Oregon, but also, I don't know if it's official actually, but I think it's public knowledge, also since this year, a non-resident senior fellow at the Peterson Institute, which of course is the most important. She also has a book titled Disaggregating China Inc. State Strategies in the Liberal Economic Order, which was published last year, and is particularly focused on the politics of China's accession to the WTO and the political economy of reform after that. So with that, over to you, John, for initial remarks.
Lovely. So many thanks for that kind introduction. So what do we make of the Chinese stock market? I'm delighted to be able to share parts of my second book on China's stock market regulation, particularly focusing on the logic of regulators as they police this casino-like market, which builds on research conducted from 2015 to 2019. So stock market regulation in China is virtually incomprehensible to most observers of China's financial markets, and this was most apparent when the listing of Ant Group, a major fintech company, part of Alibaba's empire, was unexpectedly suspended in 2020. It was aimed to be the world's largest IPO at $34 billion US, and to many this appeared to be a major overreaction by the CSRC, the China Securities Regulatory Commission, to statements made by the company's head, Jack Ma, pictured here, when he castigated the CSRC in a public forum for its heavy-handed regulatory practices. Now, the politics behind this choice were obvious enough, but it was seen as a huge embarrassment for the financial system and the Shanghai Stock Exchange in particular, because Ant Group was supposed to debut a whole new series of fintech listings. Now, financiers have long been puzzled by China's schizophrenic approach to its markets, long before Jack Ma's Ant Group debacle. On the one hand, China has sought to actively make Shanghai an international financial center. Regulators have gradually opened up the country and its markets to foreign finance, expanding its qualified foreign institutional investor scheme, referred to as QFII, creating the Hong Kong-Shanghai Direct Connect, which links the Hong Kong and Shanghai bourses, and other joint venture projects. In 2019-2020, during COVID, leading U.S. financial institutions set up shop in Shanghai, enticed by new measures that allowed them a freer hand in the securities business. But against this backdrop are a host of interventions by the CSRC, terminations of listings, investigations, price controls, that all seem to contradict China's asserted goal of becoming a real global financial sector. So needless to say, the reactions by commentators on global finance have been scathing, with frequent interventions described as warping the market, bans on shorting as preventing fund managers from using a hedging tool against inflated markets, and frequent rule changes, leading one Financial Times commentator to assert that it is an arbitrary system where the rules can and do change overnight. Now, at 12.2 trillion US dollars, China's stock market is the world's second largest and operates through two major bourses in Shenzhen and Shanghai, with a new third bourse in Beijing as of 2021. But in terms of the overall financing system, I mean, you have about 3 trillion US dollars in floating shares compared to 15 trillion in bonds and 50 trillion in banks. The vast majority of corporate financing is still very much bank dominated. Foreign ownership remains very low for the region, and it's quite volatile, with an average volatility of about 22.5 standard deviation. So, you know, but what I want to draw everyone's attention to, I guess, is the dominance of the retail sector, with 80% market turnover being driven by individual investors, which comprise about 7% of households. And I want to focus on this because this is sort of the primary explanation for the regulatory approach as given by senior CSRC regulators, is this notion of investor irrationality. As one regulator argued, the investor base in China primarily chases trends, lacks maturity, and are too impulsive. And because they drive nearly 80% of market turnover, crashes can come very quickly. They are described as chasing volatility rather than investing in fundamentals, and they have notoriously short investment horizons. Regulators decry their lack of institutional investors and the lack of financial sophistication. And, you know, these are quotations here from very senior CSRC regulators, sort of highlighting, you know, this, you know, entrenched belief that their investor base is deeply irrational. But I think the most vivid example that was conveyed to me by 2 or 3 of these regulators was the Obama and Trump effect on retail investor behavior. So in 2008, when Obama won, all companies that sounded like Obama's transliterated name, Obama, made significant gains in the market after his win. One, Alcama, which is a major cold storage group, went up by 2 to 3%, and another Alma Electrics, I think electronics, went up 6.5%. And similarly, when Trump won in 2016, any company with the character Tuan, because the transliteration is Trumpu, that also went up. And so stories of this nature circulate broadly among the CSRC regulators. Now, as such, the regulators deploy a number of hard paternalist tools. So notoriously merit-based review, in which regulators vet companies before listing. Stock markets are limited to 10% on the main boards. of Shenzhen and the Shanghai stock exchanges, and 20% on the tech boards. You can't buy and sell a stock on the same day because of the T+1 rule. You have frequent bans on shorting, listing bans for whole sectors such as real estate, and listing moratoriums that can last for months at a time when the regulator gets worried about the investment climate. And in terms of financial innovation, the CSRC has a positive list system, which places a lot of new innovations on very nebulous ground. And I'm sure you've heard about the national team of state-owned enterprises and asset management companies that go into the market hard as the market makes sort of a downward turn. This points to, I think, a very distinctive regulatory philosophy to our own here in the US, which underpins our own approach to the stock market. I mean, here we have a hypothetical rational investor, a legal commitment to the efficient capital markets hypothesis, and we have a soft paternalist regulatory architecture. Soft paternalism refers that we do have a choice architecture in place, we do have preferences, and it's one in which the state can nudge investors towards better choices, but otherwise allows investors to make bad choices for the sake of making sure that the price clearing mechanism is still efficient. But by contrast, under state capitalism, we have a very different logic. It assumes an irrational investor, and going further, the regulators do not believe their markets are efficient on account of this high degree of investor irrationality, not to mention a weak information ecosystem, untrustworthy institutional investors, and fraud. As such, the tools mentioned above reflect a hard paternalist logic in which the regulator actively constrains the choice set of investors. Now, regulators assert that they don't expect this regulatory vision to hold and eventually expect convergence on other financial regulatory models over time. But there is reason to doubt this sort of optimistic view about a transition. There is a self-fulfilling prophecy to this view of market regulation, which was conveyed to me by a senior government think tank researcher, that regulators actually realize that they put themselves in a bit of a challenging spot, that in fact, China's investors might be arguably actually behaving rationally given the uncertainty of China's regulatory system. So he describes it as follows, right? To keep investors from moving into risky stocks, the regulator frequently changes rules. In turn, investors avoid holding stocks too long, which then leads to increased volatility. The regulator sees this and believes it's because investors are behaving irrationally and so change the rule again, and so on and so forth. So in many ways, the regulator arguably is the author of the very problems they seek to resolve. Now, one bright spot in this sort of, in China's regulatory development, however, was the establishment of the new STAR market in 2019, and then the Beijing stock market in 2021, which has the same sort of rule structure. Now, China was going to roll out a new US-style registration system, which depended primarily on information disclosure rather than regulatory approval of listings. But as I spoke to two architects of the system, they made it fairly clear that there was a huge misunderstanding with the notion of registration, and that the regulator would still, in practice, vet companies. After all, one regulator asked, do you think a process of asking for more information can really address the fraud and manipulation in the market? He continued, this isn't like applying for a marriage license. We will still ask the question. Now, initially, the board did operate as planned with a number of IPOs coming out, but by late 2020, IPOs came to a standstill as regulators questioned whether candidates had quote unquote viable business operations. And as of August 2021, 40% of IPOs have been terminated, and additional listing restrictions have been added, rejecting property developers and fintech from listing in 2021. Now, I think what's interesting, just as sort of, open-ended questions for purposes of generating discussions, What are the chances that China makes a real move towards a free, standardized, and global equity market? I mean, based on what you've heard, you can sense that I'm skeptical. And as such, chances of China developing into a major international financial center are also sort of on shaky ground. China will remain highly dependent on Hong Kong, its major offshore market for IPO listings. As a corollary to the development of China's equity markets is also tied to this country's practice of financial repression. There's a reason why so many retail investors punt on the country's casino-like stock markets, because where else can they get their money to grow? So all this to say, the stock market remains, as many institutions are in China, a work in progress. So I look forward to the discussion. Thank you for your attention.
Great, thank you so much. You can now unshare your screen. Thank you, and over to you, Yeling.
Thanks so much, Nicola, and thanks again for the invitation to speak. So I've been instructed to keep my comments short. I'm going to make just three main points. The first is going to be on contextualizing China's regulatory approach in the stock market. Secondly, on securitization, and thirdly, on internationalization. So firstly, just to contextualize this regulatory approach that I think John outlined very, very well, this hard paternalism, I think is interesting to focus on, since the CSRC is generally considered more technocratic and more market-oriented compared to other economic agencies in the central government. So in this sense, it's really useful to contextualize the CSRC's regulatory approach to see, to look at the points of commonality that might run through China's economic governance more broadly. And here, I think it's useful to highlight that the fear of irrationality potentially extends to many other areas of economic governance as well. So on the one hand, economic governance officials in China believe that markets are associated with greater efficiency, just generalizing broadly. And that belief has driven much of China's reform efforts over the past decades. On the other hand, markets are also associated with potential disorder. So practices such as competitive price cutting are seen as undermining state objectives that might be oriented elsewhere. And that naturally then places limits on the degree to which the state is willing to relax its direct intervention in the economy. So even with increased market liberalization after China's entry into the World Trade Organization, Chinese policies have continued to express the need for quote unquote orderly competition. So to combine competition with a sense of the state stepping in to structure and make sure that that competition is orderly. So in that regard, the regulatory beliefs underlining what John has called hard paternalism is perhaps not unique to Chinese equity markets and is a long-standing feature of economic governance more broadly. That's not to say, however, that hard paternalism is actually an effective response, right? So even if we were to take on the premise of the CSRC that investors might in fact be irrational rather than rational, there are certain problems that are generated, right? And the problem is that these government measures create moral hazard. And I think John outlined this rather well. So efforts to prop up the index actually ends up encouraging more rather than less risk-taking, because investors then believe that the state is not going to allow prices to fall below a certain level. And so that's rather counterproductive. Efforts to protect these retail investors by using an approval-based listing rather than a registration-based listing, that's going to lead to a distortion of prices. So it makes it even harder to assess the risk if you're trying to act rationally rather than irrationally. So these are rather, I think, long-standing issues to confront. But I want to highlight a couple of new challenges as well. So that's going to lead me to my latter 2 points. So firstly, I think the securitization of economic regulation is a rather important emerging trend to look at. So these emerging, the security concerns have definitely become more salient in the government's regulatory actions in both equity markets, but also corporate governance more generally. The most high-profile case, of course, is the crackdown on DiDi's listing on the New York Stock Exchange due to data security concerns. And that's also impacting numerous other Chinese companies that are listed in the United States. But that's only the latest development. If we look further back in time, from as early on as 2013, the government had started exploring the use of the special management shareholding in media and technology companies. And that manifested itself in action from around 2016 onwards, when government-backed investment firms started taking minority stakes in the form of what's called special management shares or golden shares in very specific companies. And the minority stakes also involves board representation in the company by a government official. And this trend, in a sense, reflects growing concerns over stability, maintenance, over data security, and also the growing involvement of a different regulator, which is the Cyberspace Administration of China, or CAC. And this, is going to have broad effects on corporate governance more broadly, rather than being specific to the stock market. But it still raises an interesting question, which is whether or not there will be a regulatory clash, for example, between the visions of the CSRC and the CAC. Or is the regulatory vision of an irrational investor being combined with an additional belief of vulnerability stemming from big data, social media, and the platform economy? Does the combination add up to, is it going to add up to a deepening of what John calls hard paternalism? Will it evolve into something else? I think that's something important to pay attention to. And finally, to round off, a quick point about internationalization. So, I want to think and maybe build some discussion around economic interdependence and the mutual influence of these different models of financial regulation that John has outlined. So on the one hand, we have evidence that liberal market philosophies can and have penetrated Chinese domestic financial governance and can even be used as leverage to drive domestic reform, such as with the case of WTO entry, but also in the case of banking regulators drawing on Basel rules to strengthen the domestic oversight of the banking system. The star market that John has outlined is another example, but it's a very useful example to highlight that it's really a hybrid effort, and there's no sort of one-sided importation of a liberal market model into the Chinese stock market system. The flip side of this is the export of China's regulatory vision to other countries, insofar as many of these stock exchanges are establishing a presence in other countries. They're also partnering with developing countries to establish and grow their capital markets. Some of it is part of the Belt and Road Initiative. So, for example, the Shenzhen Stock Exchange is assisting the Pakistani Stock Exchange in terms of technology transfer using the Chinese securities technology system. So a third aspect of what to pay attention to is how this growing exportation of China's equity market regulatory approach might change the global landscape in terms of the governance of equity markets around the world. With that, I thank you very much, and I'll turn it over back to you, Nicolas.
Thank you so much. The very rich topic. Both of you have mentioned the CSRC, the China Securities Regulatory Commission, which is a securities regulator in China. Tell us more about this agency, the way you perceive it, John. I mean, we know from practice that, in the US, we have the SEC, the CFTC, BaFin in Germany, the FSA in Japan. Very different cultures between different securities regulators, just if you look at rich advanced economies. So how would you characterize the CSRC? How do you see it evolving? Is it competent? Is it highly politicized? Is it technocratic? Can you give us a little bit of a portrait of the agency?
Yeah, I think Yeling is right on the money when she argues that it is considered to be one of the more technocratic agencies, right? But, it's enmeshed, of course, in a deeply political sort of system, right? Now it's the, before it was the Yihang Sanghui, so the one bank, three commission financials with the PBOC, the China Banking Regulatory Commission, and the CIRC, the China Insurance Regulatory Commission, the CVRC, CIRC were merged, CSRC is still there, so, and then the PBOC is there. But right on top of that is the Central Finance Working Group in the State Council. And so it's playing politics where it can within the system insofar as trying to, of course, as bureaucrats are wont to do, to ensure that no major sort of issues sort of develop on their watch. So, you know, the 2015 fallout, I think, really frightened the CSRC. Xiao Gang, who was the CSRC chairman, overlooking it, was axed, and it was largely seen because a lot of the things that he had pioneered ended up sort of triggering the rout of the Shanghai Stock Exchange. So, you know, they're increasingly now this technocratic side is being reinforced by a high degree of risk aversion. And to even highlight this, you know, the star market that was eventually pushed out, the CSRC had been dragging its feet for years, right? Because, you know, they looked at the star market, it had a completely different regulatory philosophy from the other main boards. And the CSRC was nervous about what a registration system would look like. And so they were dragging their feet until the Expo conference, where Xi Jinping basically said that there will be this new star market. And this took the CSRC by surprise. The rumor mill has it that the Shanghai municipal government actually slipped that line into Xi's speech, knowing that he had this whole notion of tech innovation, right? But you just see this sort of, you have competent individuals, but they're operating within the system and then trying to manage the political risk as well. And I'll add this other tidbit, which I think is a funny one. I spoke to a former CSRC individual and asked him what his colleagues were feeling at this moment, particularly as the political side is the political influence is a lot stronger. And he said, you know, a lot of us came in because we wanted to build, you know, a free, fair, and global stock market, of course, within these within the parameters of our system. But a lot of us have become disillusioned. But the problem is right now is that it's very hard to resign from the CSRC. And the joke is that it's actually now easier to get promoted than to resign, because if you try to resign, they'll investigate you to make sure that you know, you don't have political interest at stake. Again, and an anecdote, but I think it just highlights the tensions within this system.
Stock market is an initiative of, tell us again, which stock exchange? Shanghai, right? And that's if I'm not mistaken, owned by the PBOC, or what is the shareholder structure of the stock exchanges? Can you remind us that?
Well, you know, the Shanghai Stock Exchange is not a you know, it's a quasi-state institution, right? It's not quote unquote owned by the state, it's run by the state, right? So there are partners within it.
But who are the shareholders of the stock exchange? I thought it was
I
fully public.
No, I haven't looked at that thing. So I see that Tom Gatley's on the call. He probably can give you a good breakdown of everything.
He may intervene in the chat. I encourage the audience, of course, to put questions or remarks into the chat. We already have a number of them. One of them is by Miguel Medina, who notes, you know, this extraordinarily high number you gave of 80% of daily turnover, if I got it right, by Chinese households. Are there no institutional investors, or do we see institutional investors emerging, both state-owned or private sector, company pension funds, things like that, insurance companies? Can you give us a little bit of the landscape of the buy side, as it were?
So there are institutional investors, and of course, this has been a major goal of the CSRC to sort of prop up to build a market with more responsible institutional investors. The problem has been that their performance has not been that great, right? So the retail investor sector is not very inclined to actually go into and put their money with these institutional investors. Now, there are a couple arguments about why they're underperforming, right? On the one hand, the information ecosystem is tough in China, right? So just the DD is very, very difficult for even the big institutional investors. But there's also this issue here with the type of hedging products that they're allowed to engage in. And, Victor Shi, he often makes the argument that basically, if you don't have a number of hedging products, they're basically, playing a slightly more sophisticated game than the retail investor base. And one of the other issues that a former CSRC chairman brought up when talking about, well, how do you see eventually retail investor money being channeled into these big IIs? He said the other issue is that you have fintech right now, right? So the traditional story of the average mom and pop placing their money in a mutual fund or some sort of big investor is very different than what it was in the United States, because the sort of direct access through various fintech options have really changed the landscape. The other issue has to deal with problems of lockup. So given the very short investor time horizons, the average investor actually wants to see a significant gain on sort of a 2-month turnaround time. And so, and then they will pull their money out if they don't see a good return. So there are a lot of these problems with actually nurturing institutional investors. The proportion is increasing. And so, I do, most of us expect some rationalization to sort of take place over time.
Are institutional investors, do you see them more in the state-owned sector, like,
Yes.
what you refer to, the national team, life insurers, which are SOEs, things like that? Or,
That's right.
Or do you also see private sector emerging? So, for example, private companies grow employee pension funds that end up having a big amount of money, and that creates a more diversified landscape. Can you give us a little bit more color about that?
Yeah, so I mean, the state-owned sector is very dominant, right? Through the national team, of course, as you mentioned, through the various major pension funds. As far as the private sector, the large asset managed companies are coming into play. I don't have the percentage breakdown, but in general, though, IIs, right, as a rule, have just been really underperforming. One of the things that I've been sort of covering in the book, at least, has been trying to assess regulatory assessments about why their institutional investors are not doing so well, and one of them is sort of this real lack of trust in these large market players, because a number of them have been involved in massive sort of trading scandals that have really just pushed the CSRC in the mindset that, these individuals can't be trusted. It really has to fall on the state, right, to sort of direct and sort of set the parameters for how investing should sort of unfold.
So we have Sumar Grewal, who is asking a follow-up question here. Why can't the regulators encourage or incentivize or even direct retail households to invest through institutional channels to make the market more professional? Why is there a reluctance to intervene in this manner, or actually is it desirable?
Well, a part of that is, I think the reality is it's, you can't force people to stick their money in. And so there's an economic reality that there is underperformance of these institutional investors. And of course, people love to see, the biggest, when you look at IPOs and subscriptions, in China, right? They're typically oversubscribed by a lot of these punters who love to see the price jump. This is because, of course, that in terms of sort of the strike price has been typically a little bit low, so that you see that nice bump in the first sort of 2 days, 3 days of trading, followed by sort of a crash of some sort. And, you know, but these punters really enjoy this sort of volatile market. And so, you know, during these interviews, I would ask these regulators, well, you know, why is this? And they would go, we talk about sort of the economic side of things, about, you know, the various problems and the incentive structure. And then it always would boil down to, and it's something I can't really write about in the book, but, you know, they said, well, you know, Chinese people like gambling. You know, I mean, I could never write that in an academic book, but, you know, the number of times that sort of came up was this notion of a gambling culture, a risk-loving culture. You know, this is much more on the anthropology side of things. And so, you know, the regulator restricting individuals to certain sort of, you know, channels, I think, is not seen as positive. Of course, they want to encourage as much as they can. And I asked senior stock exchange officials, maybe I'll leave it open so that you can guess whether it was Shanghai or Shenzhen, but I said, well, you know, clearly you have a sort of a retail investor problem here. And they acknowledged it, and I said, all right, so do you want to transition to institutional investors and sort of reduce that proportion? And he goes, and there are 3 of them, and they said, no, I think you're reading it wrong. We don't want retail investors to exit the market. We just want more institutional investors. And then they kind of rattled on about how, you know, this is a socialist, inclusive stock market, where I started to feel like some party line was being, you know, driven. This was as we were looking on the now empty sort of stock trading floor, overlooking it. But it was, I think that was very telling, right? That, you know, there are also a lot of reasons to have retail investors. I mean, it's great liquidity, right? It's just at the level that is in China, it creates the volatility. And, you know, as what Tom Gatley would always say is that one of the major things is that the CSRC just really hates embarrassment, right? And one of the things that they're embarrassed by is this volatility. So, you know, again, there are a lot of these trade-offs here.
Yeah,
I think one of the, sorry, just to build out that point, I think the bigger issue facing Chinese economic officials is that there's a very high level of savings in the Chinese economy more broadly, but there aren't that many channels for citizens to put their money into if they want to kind of grow their retirement pot, right? And this is also within a demographic context of a rapidly aging population. So one option, right, to kind of build more balance into the capital markets is to develop more private options like private pension plans. And there you can see the government making moves in that direction, right? So I think soon employers will be able to make more contributions to private pension plans. Right now, it's just state governed, employer managed. So, and there are some foreign companies that are also looking to be part of the picture as well. So joint ventures with Chinese banks for building up more wealth management products. So JP Morgan, I think Goldman are all sort of entering the market there. So that might build out greater confidence amongst Chinese citizens about how to structure their retirement schemes. That could then translate into lower savings and maybe less action that's just like focused on stock market speculation. I
was intrigued by your mention of special management shares or golden shares. My impression was that these didn't take off so much. So there was this new mechanism being discussed, introduced in what, 2016, 2017. But China is still very much a jurisdiction with no multiple voting rights, no special shares for the overwhelming majority of companies. Am I wrong? Is that the developing trend that we will see more multiple class share structures, Yeling and John?
That I do not know. That's a sort of a gaping hole, that specific rule. So Yeling, are you familiar?
I don't think there's a whole lot of information. One problem is that when it does occur, it doesn't become publicly disclosed. There's a time lag, right? So until 1 year later, when the share structure is disclosed, then you might find out. So it's quite opaque at the moment, right? Exactly how many of these companies do have special management shares. I believe there was a new rule that was rolled out in 2017 for news media companies specifically, that in order to operate, you do need to have this minority stake from the government. And so then the question is, how well has this been implemented? The follow-on sort of question mark around these rules is, what is the actual impact going to be in terms of government guidance over the operations of these companies? It could be that there's no change to day-to-day management at all. We just don't know, because it's a little bit new, and when the government does step in, we're not necessarily aware of it, right? So is it just going to be editorial decisions for news media companies? Will it play out in other ways? I mean, these are all, I think, things to pay attention to. The problem is there isn't that much information that's public at the moment.
Right. We looked that up with Tianlei Huang for our recently published paper on shareholding structures, and we were intrigued by the fact that it doesn't seem like it has been taken up by so many companies, including in the internet media sector. So you have one company linked to Weibo, one to ByteDance, but actually many of the large internet media companies don't seem to have this feature yet. So I think it goes back to the point you were mentioning about implementation, as opposed to the initial announcement that created a lot of noise as usual, including in the Western commentariat. We have a question from Pierre Raffi about crypto investment and indeed, whether, in a way, the Chinese investor behavior looks a little bit like what we see globally in speculative crypto asset markets. Can you give us a little bit more of a color on how transformative the crypto experience has been in China, and how you see the evolution of the crypto market kind of in parallel to the Chinese market, and where there is any read across, John?
Well, my very high-level reading of this situation is that this is considered a largely risky asset, sort of operating on the sort of gray areas of the financial sort of regulatory space. There was, of course, huge little sort of cryptocurrency little villages that would start sort of popping up with sort of young people in their 20s, sort of really going into this quite heavily. But of course, the regulatory position has been pretty clear that this is really not favored by the state. There's been, I forgot, there was reporting on the New York Times about certain crackdowns, but I think on a high level, really thinking about the nature of cryptocurrency and the way that it really is a challenge to state authority and state control by the PBOC, and the whole issue, of course, related to capital controls in China, right? Cryptocurrency is something that sort of stands, in direct opposition to a state capitalist model. And so, to what extent will you see sort of cryptocurrency exchanges expanding like we see in Tokyo or what have you, right? This is, it would strike me as very odd. Yeah.
So not exactly a libertarian policy orientation. On the moral hazard, however, we have this remark by Jean Ma that, you know, you also have moral hazard in Japan or the US. So what is really different here? The way he puts it, do you think moral hazard in China's share market, so traded on the mainland, is greater than those in the US and Japan, considering the Fed puts and BOJ buying stock exchange traded funds? Any views on that?
Yeah, I would say, you know, it's an excellent point. In fact, I was on one of my reviewer number 2, maybe that's you, you know, made this argument, of course, that, you know, we have the Greenspan put here, you know, we intervene frequently as well. We have numerous investor protections and, you know, a softening at least of the reasonable investor sort of concept. It's important to, you know, emphasize that, right? That the reasonable investor is a legal, you know, precedent here in the United States, right? That we assume investors to be reasonable, which basically is the rational investor sort of model, which creates a very different dynamic about how the state intervenes. But in practical terms, right? You know, one of the CSRC senior advisors spoke to me on this issue, where he said, that's right, you know, crisis is generally a very bad measure of, you know, how a state is supposed to behave in the market, because you just want to stop the bleeding, right? So you throw everything. There is no playbook. You just stop the bleeding, right? The difference, though, in China is that the definition of crisis is very slippery, right? And so, you know, there's this whole discussion of, you know, looking at 2015, right? The CSRC talked to a counterpart down in Hong Kong and said, well, you know, how did you think we did in terms of our interventions, right? Because Hong Kong was famous for its 97 going in very big to prop up the Hang Seng Index when it was being attacked by, you know, currency raiders and the like. And the Hong Kong regulator, you know, responded. He said, well, you've had a huge bull run, you know, like it's been too long. It's been overheated. Like yours was a good market correction. You know, this is what happens when, you know, when people are trading on margin to this degree, right? And open interest is this, you know, is X amount. This is what you should expect, right? And so that was an interesting sort of this argument here, right? Of what's a market correction, what's a crisis. And the last point on the BOJ is that it's great that they mentioned that, because the Japanese FSA, their securities regulator, actually has a much stronger relationship to their CSRC counterparts. They do things a little differently, but you know, the whole reason that the BOJ has been going in, right, is to lower the risk premium, because in their view, their investors are irrationally risk averse. So they view the BOJ's you know, exercise, typically afternoon exercises after the Nikkei drops a certain level, that it is to encourage Japanese households that are too risk averse, that have exited the market ever since the you know, the sort of last 2 decades, to come back in, right? So there is still this sort of hard paternalist sort of choice going on.
Yeah, I was about to say, this is pretty hard as paternalism goes. Yeling?
Yeah, I think we have to consider the broader personnel management system, right? So do we, you know, is there the degree of independence that we see amongst regulators in the United States is the governance system is just not structured the same way in China. So when we think about CSRC regulators, in relative terms, they are operating more technocratically, more, and they have relative more independence in a soft way, but these regulators are nevertheless nested within China's, the party state's nomenclatura system, right? So if we think about the way that their sort of career incentives are structured, right, it's not dissimilar to the rest of the party state system in terms of what's going to get them promoted, right? And there's some distortions there, as John talked about earlier. And so this is a different class of moral hazard when we step back and think about regulatory independence.
We're getting close to the hour. I would like to have a few more questions addressed, so if I can ask you to be succinct, but actually big themes. So there's a question from Paul Chu on Hong Kong, right? We've seen what's been happening in the last few years in Hong Kong. It's still a very important financial center, and it's a way to escape the capital controls and have convertibility. But there is a clear and I think now very visible decline in the depths of the financial community there, the skill sets that can be maintained, and essentially the diversity of that community. How does that affect Chinese stock markets structurally? How do you see that, the consequences of the mainlandization of Hong Kong in a way going forward, John?
Well, I mean, one of the, the Hong Kong and Shanghai and Shenzhen forces have grown increasingly integrated over time. And of course, Hong Kong's always been used as this convenient sort of offshore market for the Securities and Futures Commission, and alongside HKEX to sort of, package these Chinese firms and send them out onto the, give them access to global capital. One of the issues, of course, that the Hong Kong regulators has always been nervous about is because so much of their pipeline and IPO pipeline has come from China. And so this argument that, well, what happens as the star market starts to really grow? What happens when the Beijing Stock Exchange is going to grow? How's that going to change things in Hong Kong? And the reality is that whenever there are restrictions in China, the deal flow and the IPO pipeline is good for the regulator, for Hong Kong. But the other thing is that eventually Hong Kong is they're really trying to think about moving more into fund management. This is sort of the big sort of next step. They realize that the IPO sort of strategy is coming to its end.
Is there a chance of that? I mean, to have good fund managers, if I can put it that way, you need freedom, you need good information, you need good analysts. So can Hong Kong compete there? Either of you? Yeling on this?
Oh, I wasn't going to speak on the fund management part, but just to say that the other picture of this for this is to consider the problem with the flow of financial data right now. So many of the companies that are being threatened with delisting on the New York Stock Exchange are now considering Hong Kong as their next best option.
Right, and actually we have questions about decoupling. So Andrew Zvizdin is asking whether we're seeing a soft decoupling, bringing Chinese firms back from London, New York to Hong Kong for IPOs, listing. Do you see this as feasible, the risks? And another question, which is very much on the same theme, indeed by Tom Gatley, whether you see any prospects, so this is for the nerds, but of a workable deal between the CSRC and the PCAOB, the US agency that oversees audit firms and wants access to audit working papers to justify continued listings in the US. Again, any of you on this issue of foreign listings and soft decoupling, as Andrew had it?
Yeah, I'll quickly on the issue of sort of the repatriation of sort of Chinese firms back to the onshore or the Hong Kong market. I think what's important to realize is that this is not, this predates the sort of US-China trade conflict, right? This has been a long-term goal. It's always been an embarrassment that China's best companies, right, have been listing abroad, right, and largely on account of the fact of pretty stringent listing rules, right, particularly related to profitability and the sort of long queue that typically emerges. So, whether or not this is going to, it's the, one might say that the threat of decoupling, which I don't think we should put too much stock into for a variety of reasons, is just a helpful push in the right direction. And then as to Tom's question, do you think the CSRC is going to be happy with the sort of access? I mean, I just don't see this being worked out, because isn't that the sort of crucial issue about who gets access to what at this point? I mean, I'm sure his guess is far better than mine.
Yeah, I mean, not to be overly pessimistic, right? So just to focus on some of the bright spots, I think it is encouraging that the CSRC did respond to the delisting threat by revising some of its rules. And I think it's encouraging that the PCAOB officials, are planning to visit and they're looking for alternatives. I think the real sticking point is over the definition of a state secret, right? And that remains murky. And I think, that goes back to my earlier comment about regulatory authority, right? How much of this is going to remain in the hands of the CSRC, and how much is it going to be increasingly the domain of the CAC when it comes to issues of data security? And do they have differing definitions of what counts as a state secret? So, that sort of internal dialogue within the government is not transparent to us, but it will affect the degree to which a deal can be worked out.
To conclude, let me pick up on a question by Apoorva Schwartz on the long-term perspective. The picture you painted us, John, is very much one of, there's a long way to go, right, for the Chinese stock markets to be a serious price formation mechanism with professional investors, with, fair pricing, etc. At the same time, if you compare it with other relatively poor economies, emerging markets, the Chinese stock market is actually very developed, and including in terms of private sector listings, price discovery, churn. So if you look back, not at 2015 and the national team, but really, 20 years ago, are you impressed? Are you not so impressed? Do you think the next 20 years will bring less or more chance than the past 20 years? Can you give us a little bit of a sense of that kind of longer term path for what remains an extraordinarily large story of market development?
Yeah, I think this is, it's true, right? I mean, I don't think one should poo-poo the sort of development trajectory of the stock exchange. And looking at what were the initial goals, right? It was really, in the 90s, it was really about corporatization, right? It was restructuring state-owned enterprises and using the stock market as a tool to do that, right? And sort of sort out sort of the heavily indebted, structure of these corporations. And then, in the 2000s, it was really sort of the development of national champions, right? And so you had the whole listing of, major sort of state-owned enterprises on Hong Kong, and then bigger private enterprises out into New York and whatnot, right? So it's finished that sort of phase, right? And it's done well. The onshore market has these problems. And so we're talking about this next stage in development, right? So it's not to discount what's happened before, it's how do you get to this free, fair global market, right? Do they even want to do it? Because they've achieved so much that is in line with their general policies, and more so because, finance has always been seen as tied to industrial policy goals, right? And to what extent can you really manufacture industrial policy through a, where equities, dominate the market, it's just not the bank-led development model that we've seen, right? So it's a crossroads, and there are only hard decisions to be taken here. Do you allow the bottom of the market to fall out? Do you just, and there are only hard questions, right? And so if they just do the status quo, that's where I get my pessimism comes from.
Right. Yeling, you share that relative pessimism that they will stop in the middle of the crossing?
Yeah, I mean, I think John summed it up very, very well, right? So, even if you rest on the premise of irrational investors, the question is, what kinds of tools can you actually develop that address that, rather than creating more risk-taking behavior through those very measures? So that kind of vicious cycle, the negative feedback loop, right, is the constraint, as it were, on a further development of the stock market.
Thank you so much. Unfortunately, many questions we won't have time to address, and my apologies to Kelly Jordan, Fred Young, Greg Smith, Sebastian Claro, Marco Civardi, and others. But we'll come back to issues of Chinese financial development, of course, because it's one of the biggest stories in the world. Another big story being the war in Ukraine. So our next session will be on May 25, taking stock on the Russian economy and what's happening there after the session we had last month with Sergei Guriev in that respect. Thanks so much to John Yasuda, and best wishes for your forthcoming happy event next week. Thanks so much to Yeling Tan, and welcome to the Peterson Institute. And thanks to everybody in the audience for attending the session. Have a great rest of your day.